How close are you or someone you know to insolvency? We've got brand new data and some very interesting explanations, and it all starts right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Ted, welcome back. Last week on show number 389, you remember it as though it was yesterday.
Just moments ago.
Yes, not that we record these shows back to back. We were talking about a thing called on-demand pay, where an employee can get some of their paycheck a few days before payday. And we discussed that, well, helpful service for the employee. It's really hiding the underlying problem that many people are living paycheck to paycheck.
Right.
It's tough out there. If you had a good, secure, high-paying job, well, you may not understand because, hey, it's all good, right? But if you've owned a house for a few years,
right,
everything's fantastic. House prices keep going up. So again, that's not the experience of people who are not in that situation. So today we're going to talk about what it's really like for our clients.
Okay.
So these are people who have so much debt that they can't deal with it on their own.
Yep.
So they come in and decide to file a consumer proposal or a personal bankruptcy. So this week we released our Hoyes Michalos Joe Debtor Bankruptcy Study.
Mm-hmm.
Why do we call it Hoyes Michalos, you wonder? We've been doing it since 2011.
And at that time, no one else was doing this.
Nobody,
fact,
and
they're still not really doing it.
I mean, this is really the only study of its kind. I guess you and I must have been 30 years old back then. That was a long time ago, 11 years. So we take all the data from everybody who files with us each year, and of course we anonymize it. We're not, releasing any personal information, but we do this because we want to understand, why does personal insolvency happen?
Right. What's changed this year?
What's changed? And then, okay, can we better help people once we understand what's going on? So the entire study, for anybody who's watching on YouTube or listening, is at joedebtor.ca, or you can go to hoyes.com and type in, bankruptcy study, and you'll see it.
Right.
I'll put a link to that in the show notes on YouTube so you can get all the detail, because it would take us 3 or 4 hours to go through everything. So what I want to do is highlight 2 or 3 kind of key things that we saw in this year's study.
Okay.
So first finding is that our average client owes almost $50,500 in unsecured debt. And that's up over 3% from the year before. And that is the highest level we have seen since 2016. Mm-hmm. So let's start with some basic definitions. What is unsecured debt?
Okay. So technically, it's debt that has no recourse against anything that you specifically own or have. So I'm going to tell you what unsecured debt is by telling you what a secured debt is. Secured debt is a loan for your car, a mortgage on your house. If you don't make your payments, they can come and take something. Unsecured debts don't have those same rights. So a credit card, a line of credit, personal loan, payday loan, income taxes, all of these things, if you stop or default your payments to them, their only recourse is to take you to court to get an order saying, well, now we can go after your wages or some other thing to collect our money. So they are unsecured.
And unsecured debts are what we are primarily dealing with in a consumer proposal or a bankruptcy.
That's exactly right. One of the interesting things that this stat doesn't show is it's been all over the media that during this pandemic, people have been paying down their various credit card debts and other personal obligations. The debts for our clients have gone up. So that tells you right off the bat that we're not dealing with the same people that the media is looking at. These are the third of Canadians that are living paycheck to paycheck that have got it really tough, because it is tough out there.
That's a key point. And everybody isn't the same. Like I said,
right.
If you've got a job that's secure, you've been able to work from home, hey, the last 2 years have been great. Well, maybe not great, but it has been less bad because I've saved all the money that I used to spend on commuting and all the rest of it.
But you're a hairdresser, you're in food services, even in retail. I mean, all of these people took a whack.
Yeah, totally got crushed. So now you've raised this point about it going up since the pandemic started. What is interesting when you delve deep into our data is that, so personal loans both personal loans and credit cards, the absolute dollar value people owed have gone up.
Right.
That's exactly what you said.
Yep.
Personal loans used to be pre-pandemic, so I'm going back to 2019, were about 38% of your total debt on average. Now it's 40%. Credit cards used to be 38% of our typical client's total debt. Now it's only 30%.
Right.
So how do you explain that? How is it that the total debt has gone up, but the percentage allocated to credit cards has gone down while personal loans, lines of credit, things like that has gone up?
Well, so part of it is you're changing the people holding the debt. So if your credit card debt has gone on, but your overall credit card debt total has gone down, but your overall debt total has gone up, it means your borrowing is from somebody else. And the logical thing is maybe you're putting it on loans or personal loans, lines of credit, because they're lower interest rates. I mean, the biggie on here is, of course, there's been a shift in that the income tax obligation has gone up significantly. So you've paid down maybe your credit card debt, but the expense has been you let your tax debt get higher.
Yeah, and I think the interest rate, of course, is a huge factor in it. So if my line of credit at the bank is at, 8%, and my credit card is at 20%, well, it's kind of a no-brainer. If I've still got borrowing capacity, I'm going to use my line of credit to pay down the credit card.
And during the pandemic, the interest rate on your tax debt has been zero.
So let's talk about.
So there's an incentive to not pay your taxes to pay down your commercial
So let's talk
debt.
about taxes. And before we get to that point, just a question for everybody watching: what I just described, is that what you did? Like, if you were carrying debt on both personal loans and credit cards, if you had the ability to borrow with a line of credit at a low interest or a HELOC, which of course is not an unsecured debt, that would be a secured debt.
Right.
But have you played that interest arbitrage game?
Let's go back 20 years. So when we started, very few people had personal lines of credit. So one of our advice to people that were just finding a cash crunch, they weren't necessarily insolvent, was, well, go get yourself a line of credit for $10,000, $15,000, $20,000 and pay off all those high interest credit cards. And then the mistake people made was they ran up the damn credit cards again. So, I mean, the solution didn't work for everybody because they didn't follow it through. But during this kind of crisis, pay off the high interest debt first. Maybe you let the other one slide a little bit. That's what
what people have been doing. And if, the economy snaps back, I get back to work, great, I pay off that other debt, it's all good. The problem, of course, for our clients is, well, I used one to pay the other, and then I had to draw on the other.
Right. The prediction is as things start to pick up again, your credit card balances are going to go up again.
Which is totally counterintuitive, but you're right. During the pandemic, and we've talked about this on the show before, the people with the lowest credit scores are the ones who paid down their credit cards the most.
Right.
Because, well, they had a little bit of extra cash. That was the highest interest. They were able to do it.
And they were locked in the house.
And they
couldn't
weren't
spend the money.
Right. So as things open up, well, we get back to our spending. So you mentioned taxes. So let's talk about taxes, because this to me is even more interesting. So in our study, the Hoyes Michalos Joe Debtor Bankruptcy Study, available now, taxes includes income taxes. That's the biggest component of it. But it also includes things like HST, source deductions, if you are an employer.
So debts to the crown.
Debts to the crown. And it also includes property taxes, but that's a very tiny number in the overall grand scheme of things, because, of course, none of our clients own any real estate.
Right.
In 2021, so that's the year we're talking about, 4 out of every 10 of our clients owed taxes at the time that they filed a consumer proposal or bankruptcy with us. Our average client owes just under $8,000 in taxes, but if you just look at the 4 in 10 who owe taxes, they owe just under $20,000 in taxes, and that's just under a third of their total unsecured debt. So it's a huge component. In 2020, only 33% of our clients owed taxes, and their debt was $15,866.
Right.
So when you filed with us in 2020, it was tax debt that you incurred in 2019 or before, because that's how taxes work. You file them at the end of the year or into the next year. So it was pre-pandemic tax debt in 2020. So how is it possible that during 2020, when the economy was shut down, people weren't working, weren't earning as much money, that in that environment, tax debt for our clients who owed taxes increased by almost $4,000, 25% increase? How was that possible?
All right, well, so let's look at the basics. If you weren't working, you probably qualified for the CERB, the CERB benefit, which was $500 a week, and they were not withholding any taxes. So if you got the maximum allowed, which was what, $14,000?
Yep, 28 weeks.
And they didn't withhold any tax, and you're an average Canadian, they should have withheld 25% tax on that. So suddenly, this $14,000, you owe $3,500 right there on your taxes. So you haven't done anything wrong. You just, bang, that's a big chunk of that $4,000.
Well, and we did say that the average taxes increased by $3,900. Well, there you go. If you happen to be in the 25% tax bracket and happen to get the full amount of CERB, then boom.
Well, and when CERB died, there was the CRB, and they only withheld 10% on that. So that might be the rest of it. But the other thing, of course, was that CRA has not been aggressively collecting during any of the pandemic. And so who are you going to pay? You're going to pay the people that are yelling at you the loudest. The government's not yelling at you at all. we'll deal with somebody else.
Yeah, that is an absolutely key point. And we know that in 2020, there were 9 million Canadians who got CERB.
Right.
And we know that, like I said, the tax debts are up 25%, but the insolvency filings in 2021 were at a 20-year low.
Right.
You just said why. It's because there's no pressure yet. And so CRB, which only came in at the end of the year, it started September 27th of 2020.
Right.
And then went into 2021, which, of course, the 2021 tax debts are not reflected in these numbers yet.
And the other ones, we're all filing our 21 taxes now.
Right, exactly. So and as you said, with CERB, there was no tax withholding. With CRB, there was 10% taxes, but there's another
There's
kicker.
always a but.
Yeah, you will be required to repay, and I'm quoting directly from the government's website so I don't get this wrong. You will be required to pay 50 cents of the benefit for every dollar in net income you earn above $38,000, excluding the amount you received for the CRB, the Canada Recovery Benefit, up to a maximum repayment of the whole thing.
Right.
So amounts repaid will not be included in your taxable income. That's nice of them. So if in 2021 you worked part of the year, well, that's quite plausible because there were lockdowns and openings, and you got CRB for part of the year, and your net income was $50,000, which is a number I just made up. You can tell me if that's realistic or not, excluding what you got on CRB. Okay, so that would have had to have been a pretty good job.
$25 an hour.
Yeah, but that's $50,000 just in the months you were working. So okay, that you were working a lot of hours, or you had a pretty good job. You're $12,000 above the limit because the limit's $38,000. So if you got $12,000 in CRB, you have to pay back $6,000 of it.
Right. And
if you live in Ontario and you had $50,000 in taxable income, your average tax rate is about 15%. So you still owe 15% on the other $6,000 in CERB you got. But they only withheld 10%, so you owe another few $100 on that. So I think some Canadians are going to get hit with a big tax bill in 2021. They got hit with a tax bill in 2020 because of CERB, and now there's a potential tax bill for 2021 for CRB. Do you see that as a problem going forward?
Expand on that thought. I think there's a significant portion of Canadians that haven't filed 2020 yet because they knew they were going to owe. And they're going to have the same problem again for the 2021 taxes due this spring. They're going to delay filing until somebody tells them to because they know they owe money. So I think the problem's only going to get worse.
Yeah. Because how can it not get worse?
Right.
Like, there's really
the government could forgive it all.
They could, but we are in, big deficits and all that kind of stuff.
Right.
And I don't see the political will to do that at this point. I don't know, maybe. We're recording this in the middle of February. So at the start of February, the government CRA did send out another whack of letters saying, we've done some more math.
Right.
And it turns out we don't think you qualified for CERB.
Yes.
And because there were rules, you had to have made over $5,000 in the previous year. You had to have income of less than a certain amount.
Right.
And it took them a while because they had to process all the 2020 tax returns to figure that out. Right. So there are people who are now getting those letters. Those letters, I assume, are only going out to people who actually filed their 2020 taxes.
Obviously.
Because otherwise, how could they do the math? Right. So you're right. If you don't file your taxes, well, then you're not eligible for things like the Canada Child Benefit,
which is a huge for families, obviously.
Right. So, okay, if I've got a kid, I pretty much have to file my taxes, but now then I'm incurring this potential other tax debt. So I agree. I think it's going to be a big issue. Now, CRA is not charging interest right now.
Not till April. I'm sorry, May, I guess.
Right? Yeah, until the end of April. So CRA is not charging interest on your 2020 taxes until April 30th, 2022. So you're right, in the beginning of May. If your 2020 taxable income was $75,000 or less, and you received at least one of the COVID benefits, like CERB or CRB or one of the other ones,
right,
and you filed your 2020 taxes.
Right.
So if you filed your taxes, they're saying, okay, no problem. You owe the money, but we're not going to charge you interest. So that's yet another whack. Like, why would I be paying my 2020 taxes now if it's an interest-free loan?
Well, particularly if I owed money on any of those other debts.
Which we just described.
We saw you did, right.
Yeah.
So you pay down your credit card debt at 19 or 29%, and you don't pay your taxes because, well, what the hell?
So you're kind of kicking things down the road here.
We're certainly kicking things down the road, and it's only going to get worse because once that interest kicks in on the taxes at 17% per annum, it adds up very quickly. And the government, they may not be the brightest people in the world, but they're like a dog with a bone. Once they latch into you, they're going to keep going until they solve the problem.
Yeah, it's in the computer.
Right.
And so even though CRA employees, for the large part right now, and again, we're recording this in February of 2022, are working from home. And as a result, it's much more difficult for them to be issuing requirement to pay notices and all the other pieces of paper.
No printing Thursdays.
Yeah, exactly. Well, we just heard that this morning, that a CRA person said, I can't get you that piece of paper today because it's Thursday and we don't print on Thursday because there's no one in the office.
Right.
We'll have to wait a couple of days till we're back. When they eventually get back, or they figure out how to remotely print something,
right,
which isn't that hard, then there could be a pretty big wave. So I think it's not going to happen in February, March, or April.
It's going to be an avalanche.
There's going to be an avalanche.
It's coming. So you start with a little snowball, but eventually it just gets to the point where you can't deal with it.
Yeah, and we talked about this on our New Year's predictions podcast, and I think I made the comment that, well, it's probably, late summer, early fall by the time they've got 2021 assessed.
Yep.
They're kind of quasi back in the office. That's when it's really going to hit. So taxes, I think, are probably the biggest story that we're going to be talking about for the rest of the year. Now, the third finding that was equally disturbing is student loans.
Yep.
22% of our clients have student loans at the time they file a consumer proposal.
So 1 out of 5.
This is the highest percentage we have ever seen in the 11 years we've been doing this study. When we first started back in 2011, 2012, we were in the sort of 12% range.
Right.
Now we're clearly 10 points higher than that. Of our clients who have student loans when they file, the average student debt is $17,000.
Right.
It was under $15,000 before the pandemic, so it's gone up almost 15% in 2 years.
Mm-hmm.
That sounds like a big number to me. So why is that? Well, one theory is, during the pandemic, more people went back to school because they had no job and they could, go to school remotely. Do you buy that explanation?
And that doesn't make any sense to me, because the people that are including student loans in a bankruptcy have generally been out of school for at least 7 years. So what the law says right now is your last time you were registered as a student has to have been at least 7 years for us to be able to eliminate your student loan debt in a consumer proposal or a bankruptcy. And our study showed that the average debt is 12 or 13 years they've been out of school?
Yep.
And so that means the people that we're seeing in 2021 with student loan debt were in school back in 2008?
Yep.
Right. And so, the pandemic had nothing to do with that. The pandemic probably impacted the types of jobs that these people had. So if they were already in service industry jobs, when the shutdown happened, they got laid off, or any of the self-employed people that couldn't see clients, all of those folks got impacted. And what's distressing for me is that the bias there is towards women. But the study shows it's
61% of student debtors are female.
Right.
And on average, they are 36 years old at the time they file. And as you said, they've been out of school for 13 years or more.
And we ought to look up to see what the dependent number is for them, too, because I bet they're single moms.
Yeah, it's very common that that they've got one dependent. And so you add all those factors together, or they could be caring for elderly relatives, too.
Right, that's part of this, too.
And so you throw all that together, and they've got a student loan that they are not able to service. But it's not like they went to school yesterday.
No. And so this is a troubling indicator. What are the next 3 or 4 years going to look like? I think this number is going to continue to climb.
Well, and I already mentioned the naughty word to you once, but I will mention it again. Of our clients with student loan debt, they had $17,000 in student loan debt, but their total unsecured debt was $52,000. So the student loan debt is just one issue.
Right.
Student debtors are highly likely to turn to payday loans.
Oh, you had to work that in.
I did. With 44% of them carrying at least one payday loan. Right. So these are people at the end of their rope.
Right.
I've been carrying this student loan around for 13 years.
Yep. Haven't been able to deal with it. I have not been able to find a job earning sufficient income to pay it. But in addition to that, I've had to incur a bunch of other debt to support my family, to just live. And I'm so far down near the end of my rope that almost half of them have to go and get a payday loan. Right. So we're not living paycheck to paycheck anymore. We're living off next week's paycheck before we even earn it.
Right. And again, it's going to get worse because right now the federal government has waived interest on Canada student loans until March of 2023.
Right.
So that's more than a year from now. And they also made repayment assistance programs easier to access, lowering or eliminating repayment needs for lower income households.
Right.
So again, serious problem, but it is kicking the can down the road.
Yep.
So the problem is bad now. It's likely going to get worse in the future. So the future is bleak for tax debtors. I assume you believe the future is bleak for student loan debtors too.
Yes. I mean, that's right.
They're just not, the money isn't coming in to allow them to deal with it. And it's unlikely their income is going to spike upward anytime soon to change it.
And their income is not going to keep pace with the expenses that are spiking right now. Everybody's seeing that.
So this is a long-term problem, obviously. So the pandemic has changed the work profile of the average debtor. Okay, that's no shock there, right?
Yep.
Historically, when you look at our study, 80% of our clients were employed.
Right, actively employed.
Actively working at a job when they filed.
Yep.
But in 2021, last year, only 70% were employed. That's a record low since we started doing this study. 15% were unemployed, 6% were retired, 9% were getting disability, maternity leave, something like that. Almost half of all of our clients listed job loss, business failure, or income reduction as a primary cause of their insolvency. Not surprising.
Yep.
Average debtor income fell 2%. It's now down under $2,600 a month. The average household income, if there was another person in the household, is down even more, 2.6% to around $3,000. So you're the math guy here.
Right.
You get to do the math. How much, when you're carrying that level of debt, does our average client have to be able to service the debt that they've got?
You're going to have to dig into all the numbers, folks, but take my word for it. What we've determined is that at the end of the month, our average client last year had about $203 available to service their debts. Do you remember what the debt number was?
Yeah, almost $60,000 in consumer credit.
Right.
So and consumer credit includes not just the unsecured stuff, but also my car loan, for example. And when we did the math on that, conservatively, it's about $1,200 a month in debt service costs.
I got $203 to pay it.
Which is hard if you've got $1,200 you need to pay.
Right.
And there's your math problem right there. And when you do the math, okay, we split it up. Payday loans, very high interest. Credit cards, high interest. The other one's less. But that's what we came up with. Around $1,200 a month I need to be paying just to service the debt.
Right.
But when you take my income and subtract my living expenses, I've only got $200 a month. So that's bleak. I mean, this is kind of bleak here.
Yep.
So hopefully you can come up with something a little more. I'm getting choked up here just thinking about it. We've got more student loan debt. Incomes are down. Expenses are up. Debt is up. We're not quite sure what's going to be happening with the economy. Then we got the tax man coming, which is going to happen later in the year. We've kicked the can down the road. At some point, we're going to have to pay the piper. So is there anything good you can say about any of this, or do we have to end on that depressing note?
Well, I think the important thing here is to keep a perspective. So the pandemic has accentuated a number of very unpleasant things for people. Carrying too much debt, relying paycheck to paycheck. I mean, cash is king. You got to have the money to pay your bills. And for a large percent of the population, that support structure is kind of fallen apart. And so I would be thinking, now's the time to seriously look at all of my different options and remedies to deal with my debts. Nobody really wants to talk to a bankruptcy trustee because, quite frankly, they somehow feel that, okay, I've failed. Well, you didn't cause the pandemic. You didn't cause your employer to lay you off for 6 months last year because the government said you can't go to work. It may be time that you finally take the bull by the horns and say, all right, I have to deal with this problem. And frankly, the best advice is, if you think you've got more debt than you can deal with, talk to somebody that can help you assess that, make the determination.
Yeah, and we issue this study and we go through all these numbers to illustrate that you are not alone.
Right.
So now it's true. There were a very low number, historically speaking, people who filed insolvency in 2021. It was somewhere around 90,000 in Canada, which is still a massive number.
Well, pre-pandemic, it was 130. So.
Yeah, and if you go back to like 2008, 2009, it was 150,000.
Right.
But 90,000 is a massive number still. And the reason it's so low is because of all the reasons you said.
Right.
Collectors aren't collecting.
There's very little pressure. The people that filed in 2021 are the folks that, for their own personal reasons, decided now is the time to do something. It just got to be more than they could deal with. Once you add back all of the collectors that are going to start happening this spring and this summer, I think these numbers are going to get very high indeed.
Yeah, 70% of our clients were employed last year. Well, as the economy gradually reopens, we'll get back to a more historical number of 80%.
Yep.
And of our clients who aren't employed, a lot of them, I mean, yes, there are some pensioners and whatnot, but a lot of them, it's like, well, I'm starting a new job in 2 weeks.
Yep.
I want to get this dealt with now before I go to a new job and have to worry about any kind of wage garnishment. So my guess is, historically, throughout the life of a bankruptcy or proposal, it's more like 90% of our clients at some point are working. Well, that's going to change, obviously, as the economy opens up.
Right.
So you got the double whammy, people going back to work. Now their wages are subject to garnishment. And you got the collectors who are increasing their collection activity.
And you got the tax man just waiting.
So it is a serious issue. So I agree. I think this is something that there's kind of, we're in the eye of the storm right now, right? There's a bit of a lull.
Yep.
It hasn't really hit yet. And that's a horrible thing to say because we've just gone through 2 years of hell.
Right.
But the collection activity hasn't hit. The pressure hasn't really hit. So I agree. You might as well take action on it now.
Yeah, the point I was making is if this is making you feel bad about yourself, then use the pandemic as the excuse. Okay, I know I might have had things were really tight, but the pandemic made it much worse, and now I've got no choice. I need to get relief from my debt so I can look after myself, look after my family, and I can have a better future going forward.
Yeah, I think the events of the last couple of years have accelerated and amplified what was already there.
Correct.
So your debt, I mean, I guess there are some people who had zero debt when the pandemic started, and now they have a huge amount. But more typically, well, I had some, and it's kind of been ramping up and maybe really accelerated since it happened. And that's like everything. The use of our technology, well, that accelerated quite a bit. Yep. We didn't do video conferences before, and now we do them all the time.
It's going to get worse just because gas is now $1.50 a liter for regular. 3 liters of milk is going to cost you $6. It's everything else has gone up. Your wages haven't gone up as fast if you were working at all. So now you get back to work tomorrow. It doesn't matter. It's still costing you $300 or $400 a month more to live.
Yep.
This year than it cost you last year.
Yeah, and so you've got to be looking ahead and going, yeah, you know what, maybe I got to do something. So we suggest you give our office a call. You go to Hoyes.com. You can contact us. We're not saying you need to file a consumer proposal today.
Nope.
And in fact, a huge number of people who've contacted us over the last couple of years, we've said, okay, let's do this at the right time for you.
Correct.
You don't have to do it today. Maybe you wait until you've gone back to work. Maybe you wait until you've got your taxes filed, whatever it is. But we can get it set up so that you know what your options are and you can decide it at that point. The other reason we did this study, so I want people to understand that they're not alone and you've got options. But I also want to illustrate that, and you made the point, there's sort of a third of Canadians who really got absolutely hammered by this.
That's right.
There's a third of Canadians who did fantastic as a result of this.
I mean, their tech stocks went up, their real estate went up. All these guys that are at the top of the food chain had a pretty good couple of years if they could, put up with staying at home.
Right. And so if you're one of those people who really benefited by this, good for you. But remember, there are other people in the other segment who
For everybody
did not.
that benefited, there's at least one that suffered.
Yep. So it's tough. So I think the positive thing we can say is, number one, there are options to deal with it. And number two, it's got to get better. Can it possibly get any worse?
It's going to get better.
Yes.
All right?
So I agree. It is going to get better. Now, maybe not tomorrow. Maybe it'll take a week. Maybe it'll take a month.
Right.
But I think the economy does open up and things do improve. So you might as well start looking forward to that and making whatever plans you need to do. So if you have debt, and in particular tax debt, because I think that's going to be the real killer.
And nobody's even thinking about it yet.
No, and that's the kind of debt that doesn't get better on its own. I mean, if you've got a cell phone bill from 5 years ago, okay, they leave you alone, they can't sue you, whatever. But tax debt, it never goes away. It just keeps accumulating. So it's better to reach out for help now and come up with a plan. So again, Hoyes.com, we're available to help. That is our show for today. All of the details on this study are at Hoyes.com. Again, you can just type in study, or you can go to joedebtor.ca if you want a direct link to it. And all the data is there so you can see what we're talking about and where we're getting all the numbers. So Ted, thanks for being here. For those watching or on YouTube, please like, subscribe, put in a comment, do the notification bell. What else are you supposed to do, Ted? You're a big YouTube.
Yeah, that's
guy,
social
right?
media, right?
Yeah, that's right. Ted has no clue. I don't know if YouTube's social media, but make sure you subscribe so you get the updates. If you're listening on an audio platform like Apple Podcasts or Spotify, again, subscribe. Every Saturday morning we have a new episode, which we will have again next week. And until then, thanks for listening. I'm Doug Hoyes for Ted Michalos. That was Debt Free in 30.